How's it going, everyone? It's Sam. Today I want to talk about two dividend stocks that pay about 5% or more. And to be clear, I do invest in dividends. I know I mostly talk about crypto on this channel and talk about the general markets and macro, but I do have a hedge with dividend stocks. It's not a large portion of my portfolio, probably about 5 to 10%. And one portfolio is one that I'll show you here today. It's only a smaller percentage of my overall dividend stocks. I do have other dividend stocks in other accounts, but I want to show you this because I think these companies are good companies. I think that they do have potential, and not just because they pay high dividends. Honestly, when I'm looking at dividend stocks, obviously I make sure that they pay a dividend, but I'm really just looking for compounding stocks I think have really good fundamentals. And if they pay a dividend, that's great, right? It's just an added bonus, but that's not generally what I look for when investing, right? I have crypto, it doesn't pay anything. I have other companies that don't pay anything because they just use their money to reinvest in themselves. Eventually, one day, they probably should be paying dividends because they'll be making so much money, they won't have anything else to do. But at this point, again, dividends are just a small portion of my portfolio, but a couple of these companies I want to go over the bullish thesis because I think they, again, have some potential. Now, I am not giving recommendations to buy these. I just want to talk you through some of my thought process. The first one is one that I have never talked about on the channel. The second one I've talked about a few times, but I haven't maybe gone into the bull thesis in a while. I also want to thank Monetary Gold, the sponsor of today's video, but we'll talk more about that in a bit. There are also our timestamps in case you want to skip around. Now, this is my dividend and income growth portfolio. This is a portfolio where I invest $150 a week. At first I invested $100, now $150, and I just do this consistently. I get dividends every week, every couple weeks. I don't hold like 40 different companies like a lot of people do just to, get a dividend every week or every few days. I'm really just buying about 5 to 10 companies that I think will do really well over the long term. And I'm collecting those dividends, reinvesting them with $150 a week. Now, again, like I said, I do have money in other portfolios that are in some of these same companies. And I think these could be pretty interesting. So first one is one that I just bought for the first time in years, and it's a bank stock. So first of all, I want to say the bank stocks are risky right now. The whole sector is pretty risky, so you have to be very careful. First of all, if you're investing in bank stocks, but also just be careful investing at this time because we've never seen a collapse like this in my investing career. 15 years ago, we had banks going down, but these are some of the largest banks we've ever seen go down, and they're tumbling like flies. A lot of them are exploding very quickly, and that's causing a lot of fear in the market. But that also causes some nice buying in prices. So one company that I'm buying is Comerica, CMA stock. Now, you might not have ever heard of this. It's a regional bank in Michigan, Florida, Texas, California, and Arizona, I believe. And just a few days ago, it went down to $32. Unfortunately, I was watching it, but then I had to drive and I couldn't buy it until it hit about 45. So I'm down 1% or 2% right now. Now, this is a company that survived the 2008 financial crisis. Did pretty well. You can see it's been around for a long time. Obviously went down a lot during 2008, went down to $15. During COVID, went down to about $21. I was actually working at the company during the beginning of COVID and before COVID even happened. And it was a rough time. The company itself did really well because you have to realize this is a very, very conservative company, very conservative bank. So when you think about some of the risks that are happening in banking right now, like what happened with Silicon Valley Bank, Comerica is pretty much the opposite. For example, I'm a client there still, and I have a decent account balance there. I did not get offered an interest rate until very recently. Now it's a competitive rate. It's around 3%. But for months and months and months, while everyone else was vying for your business, trying to pay you money on your deposits, they weren't. So you might say that sucks as a client, right? And they did have some outflows in terms of deposits for that, but they're also making a lot more money because they don't have to pay anyone anything. So That's just something to consider. I don't think they are the same type of bank like Silicon Valley Bank that's been doing a lot of risky stuff, right? So that's one point of this. They pay a very consistent dividend. I mean, for 4 years, they're paying the exact same cent amount, basically, not raising it at all, just, taking in the free cash flow, EBITDA positive, just paying out dividends, really low payout ratio. Revenue was stagnant for a while. You can see that it did grow since about 08, it fell down around that time and then started to come back, and it doesn't look that significant, but we're talking about 2.43 to 3.53. So over 10 years, increasing about 40%. EPS is positive. Now, like I said earlier, I think the dividend is relatively safe. Of course, depending on what happens with the economy, they might have to lower the dividend, but the payout ratio is 32%. So it's not very high at all. And they pay now a 6.53% dividend ratio, dividend yield. They have grown it over the last 5 years, but they did that in one big chunk and then they've just kept it the same. So right now, I think that this is a pretty interesting opportunity to be able to buy it after it fell down really quickly. I mean, we're talking about it fell from basically $75 to $43 in a month. And the price to book is still a little bit high compared to where it has fallen in the past, like in COVID. But the book value per share has also fallen down a lot. During COVID, the book value per share was $53. Now it's coming in at $40. So I think this will probably rebound, assuming the economy is okay. And then the book or the price to book value ratio will go down pretty significantly, in my opinion. But again, this is a riskier stock. It's a very high dividend stock right now. I'll probably not hold on to it forever just because I don't think there's a lot of growth here, but they are a conservative company, so I think they're going to be insulated from everything that's happening now. I might just have to wait out a few months or a few years to get back to, $70, $80 per share, and I'll be able to collect a nice dividend in the meantime. That's just my thought process, though. Now, on this channel, I talk about diversification a lot. There are some indicators that we are heading towards recession. There's a question whether we'll hit that soft landing or not, but BlackRock is now saying that they're ready for a recession unlike any other, and what has worked in the past won't work now. There's a huge inversion of the yield curve, basically the highest that we've ever seen. Gold has done pretty well in the past couple recessions. If we look here, actually 1990, it's the worst return, and it still did about 9% in just a very short period of time. If you look here, 2000, we were really at the bottom, around 446. Over the coming years, it went all the way up to over 2000. In 2008, it fell down in the middle of the recession, but then came right back up. Then even in COVID, it did pretty well. Now, I am partners with Monetary Gold. I'll put a link to them underneath the video. You can call them as well. And they basically allow you to buy gold and other precious metals. They have over 50 years experience, and they have a large selection of gold, silver, and platinum. They have free shipping, and you can actually get IRAs, precious gold IRAs. You can also buy stocks and other stuff in them as well. You don't just have to buy precious metals, but I'll put a link to them underneath the video. Of course, always do your own research. Big thanks to Monetary Gold for sponsoring this video too. Now, the second stock on this list is Vici Properties. I've talked about this before, and I think it is a pretty well-known stock now. It's a REIT, so it owns different properties, specifically in Vegas. They have exposure outside of Vegas, but they're really well known for owning properties in Vegas. You might know them because they own Caesar's Palace. They own a variety of other properties as well. And like I said, they're really well known for this now because they have some of the most well-known properties on the Strip. Now, part of the bull thesis on Vici is the fact that Vegas is growing pretty quickly. Casinos across Vegas brought in $14.8 billion in gambling revenue in 2022, a new annual record, and it increased 10.5% from 2021, when the state had set its previous record of $13.4 billion. Vegas in the beginning of this year is also growing quickly. Nevada posted gaming revenue of $1.27 billion for January, which implies an 18% increase from 1.07 reported in January 2022. So last year they grew like crazy. This year it looks like they're set to continue growing like crazy. The population of Vegas is also growing. So the population of Vegas is now 2.9 million, a 2.11% increase from 2022. So on the list of the fastest growing metro cities, metro areas, Las Vegas makes the list, but if you look at just the last year and you annualize that out over the next 10 years, it would be about the same growth as Austin. So it's growing like crazy over the last year. And gambling revenues are really strong, showing that more people are coming there, more people are moving there. So the value of the properties that they own are going up. So that's part of the bull thesis, right? And you can't necessarily look at the same metrics for Vici that you look at for other companies, because for real estate, they could just get more debt and then have more revenue, right? That's one way, because they're basically creating acquisitions or making acquisitions of properties. So you can't just look at revenue growth. You can't just look at earnings overall or free cash flow even necessarily. You really have to look at some different metrics, which we'll show here in a second. But right now, the company is continuously growing dividends and continuously growing in general. It did really well last year. It was actually the best performing REIT. So I realize I'm going a little bit everywhere here, but there's a reason for the price appreciation in the share price. First of all, like I said, the area itself is growing quite quickly. They own some of the best properties. They're not really exposed to all the risks of these companies. So the nice thing about owning real estate in Vegas is you're not having the same boom and bust cycles as the companies underneath you, right? For example, let's say Caesars has a great year, right? They make twice what they made last year. That's fantastic. VG isn't necessarily that affected by it. It's great because they're going to be able to collect rent, but it's not like they take a profit cut. Now, the same can be said for the reverse side, right? If Caesars has a really bad year and they lose a couple $1 billion, well, VG still gets paid. Unless these companies go bankrupt, they still get paid, and it's very hard to move, right? The Caesars would have a very difficult time just pulling all their operations and leaving the building. They have contracts, and just the logistics of that would be insane. So they're beholden to stay to these buildings, basically. They have to. Vici itself has collected 100% of collections through COVID-19. So they did a great job continuing to get rents. They've acquired some really big companies. For example, they announced the $4 billion acquisition of the Venetian and $17.2 billion acquisition of MGM Growth Properties. They were able to get these at really good cap rates, and they're able to lock in debt. So that's one great thing about this company too, is they've been able to make a lot of acquisitions that are at very low interest rates still. So it's actually accretive to the shareholder. So they might buy a company, right, and their revenue jumps and their debt jumps, but it's still better per share than they were before. So that's an awesome thing, that they just continue to swallow up good deals. It's basically like if you had a real estate investor just continuously buy up properties for you, but you could just put, a couple $100 in them. Now, the other thing is they are very insulated from inflation. They have CPI kickers or escalators in their contracts. So basically, if CPI continues to go up, well, Vici is going to get more rent. And this is in 96% of their leases over the long term. So if inflation continues, this is an interesting stock to hold, because the dividends should be able to continue to raise because they're going to make way more money and their costs are fixed, right? So as these properties pay more and more, as they get more and more rent, the margins will grow pretty substantially. Now, the other thing that we have to look at is just their growth overall. And it's hard to look at because, again, revenue and earnings per share can be messed around with real estate investment trusts or REITs. So what we really want to look at is the AFFO per share, basically the adjusted funds from operation per share, and we want to make sure this is growing. Basically, this is another way of looking at profitability. So the AFFO per share was 51 cents for the fourth quarter last year, compared to 44 cents per share for the quarter ended December 31, 2021. So they were able to grow pretty substantially, right? Over 10%. their adjusted funds from operation per share, basically showing, yes, you are making more per share than you did a year ago, significantly. And if we look at a year basis, so all of 2022 versus all of 2021, the AFFO per share was $1.93 compared to $1.82 the year before. So not as quick a growth overall, but that shows that they really crushed it in that fourth quarter. They really were able to add a lot of AFFO because this would put them on track for $1.02 just based on last quarter's AFFO per share. Now, they're also expecting some pretty substantial growth this year, right? They had $1.93 last year. They're expecting $2.10 this coming year. So they're continuously growing, and that's the lower end of their guidance is $2.10. They're continuously growing, continuously expanding, buying more properties at good rates with a sticky business model with CPI adjusted rents. So I like this company. I think they're going to be able to continue to raise rents. I have a good portion of my money in Vici. It's my largest dividend stock that actually pays a substantial dividend, unlike Microsoft or Apple, right? They pay a smaller percentage. This is the largest holding that I have that pays over about a 2% dividend yield. So I really like this company. Comerica is a much smaller company for me in my portfolio, but I wouldn't mind averaging down a little bit if it does fall from here. But let me know your thoughts on this underneath the video. Do you think it makes sense to be buying bank stocks at a time like this? And do you like Vici? Thank you so much. Let me know your favorite dividend stocks, and I'll see you in the next video. Bye.